So it's really
That's why. So the risk is really low.
doorstop.
It's really low.
Literally, I know we have active management.
Als gewoon hard because relatively speaking,
I think it's hard. Well, it was it's easier.
I'm more easy to
Pivoting to
not the same that
retail is
markets like
Yeah.
Stocks
I would bring up nearly.
although you do have some reasonable much the beta rates. Right? So they do have the beta rates that all the college becoming do well, all the network. Besides that, we haven't seen the companies going to some products. Right? Company is the leader.
What a great opportunity. Nice to meet you.
Nice to see you.
Yeah?
Yeah. I'm from the accounting department of Ford.
Okay.
Yeah.
Terrific. So that's a good place to be.
Yes.
Good. How long have you been in?
This is my
It's so low actually because also you run the risk of losing.
so one of the big employers for our students. Yeah, our accounting, I hired two.
It is?
Actually, the former AG average stable is over there.
You guys can join. It's kind of like.
Matter of fact, the former AG stable is everywhere.
Yeah, I teach math students, master students. The math students go to Iran. Yeah. That's right.
I agree that is definitely that like we have one little bit out of the market
Very smart.
Very smart. But no, you just hire roughly how many accountants?
I'm the chair of the department, and we have 83 students enrolled last year, and this year we're seeing probably it's about the same level. So if the big employer is really a must for our students to find a home. And do you have how do you know that our students are international? Yeah, they're very nervous about this new administration, direction, and so however, how do you deal with their visa status?
But it is in America. That's about 400. This is 85.
In this case, usually it's in spring.
Program, and we're going to give the new schools help them to get quantitative stuff. Thank you. Yeah. Just copy. Thank you.
It was great. It worked out really well. This was
Long weekend. Enjoyed doing that.
so you got it.
There's a four networks.
Right, so we open up the suites, we call the suites of the master program. I know. Think county analytics, consumer
Gina Redding did this to me.
spectrum of programs.
Well, those just don't know why. Norman, I want everything. A lot of it's
Explore.
Okay, sure. Yeah. you have a bit of a
require somebody else.
We call MACC. Right.
Ask 1,000 questions later.
Master of Accounting, ACC, represent accounting. Yeah, and we have a traditional accounting track, which is study the
Well, some of it, well, they outsource it all.
and because of the new move into the AI based, right, data-driven demand, and we open up a new track that's called MACC Analytics.
Yeah. Everybody kind of say, oh, we have these heroes.
So we create this program, I think 1 to 1.5 years. For those who are international, they can have a half-year horizon to settle their visas, they can settle their internship. Whereas for domestic students, they have the option for 1 year.
So I don't know if one's affecting the other. So what if it goes up too much and then it's.
Oh yeah, quite many.
literally
And there's master, again, they can use
engineering.
But there was the thing going on that was another sports So my thing is
I used to go with founder's name on the company.
That was great.
Mike Don, really nice to meet you.
US firms. No, he decided to because he has a day next to me. Greater than negative returns.
I know that
Management. Like
I know that
so you gotta get out of
It's the end of the world, right? That's why I gotta get my points.
have aspirations for this brand name, and they are. China is so big, and there's a huge demand for education, and because their parents are getting wealthier, right? So they can afford for doing this. I told them, so I'm teaching them back. I told them, I cannot afford when I was working. I cannot afford to come over here. It's so expensive, and but they have the luxury to afford, and the majority of them are doing well, I would say. But of course,
it impacts business.
That was like,
Sure. And our undergraduate students have the option for master program without user tuition, and majority of the undergraduate students have this math option. Actually, they are fantastic students. So I have some diversity there, and we hope that they can make this
useless bags.
more attractive.
That's why my hard drive's so overloaded.
It's just great.
Very good to know because we're thinking, they need to make this some kind of support.
There's something to
Years ago, not many people knew how to Stanford, MIT, right? Washington is making the my base in China. And actually, I met several alumni based in China, Shanghai, Beijing. I think their presence is pretty strong. So that awareness, and also because of the wealth, right? They're wealthier, they're able to send their kids here, and then they go back, they bring the name back.
Well, mission integration, mission integration, not
MIT,
sorry,
China,
but no,
and
it's getting tougher to bring
Beida.
international.
Like, they of course always, Leo, we've got to be our
So what maybe you have what labor will this?
I'm an accountant. Our accountant care about what managers say. Basically, accountant care about information. And what managers says about this is about accounting or basically information related to the market. How they act on their information. So that's what I care about. And then I said, managers, they make real decision making based on their own information. Then that potentially has asset pricing implication. Then my co-author, he's the top researcher in asset pricing. So we say that's a perfect marriage, right? Between accountants and finance. So that's how we started.
I want to hear. I did not read
It's very simple. Yeah.
Oh, it is. Where? Outside? Oh, right there. Because I listened to the rulings, that's what I do. And I listened very
Institutional projects are programs are operating.
They can extract a lot of information.
Never missed a step.
I switched careers at one point and went into academia to study history, Roman and the treasurer for a number of academic organizations. For accounting it was. I'm not sure take the exam. If you have other interests,
down in his basement and kind of see where they, I always thought I'd come back to that. Maybe so just get a doctorate in history and then come back. Everything else in the opportunities are pretty good. So we can do that.
And also did some time
Yeah, well, so, well, I had a,
so I own a absolutely, our research team, like in my accounting department, they look at the how many times they calculate it as we.
Work on a lot of manual, so.
All right, we're going to go ahead and get started. I'll encourage all of you to keep eating your lunch as we're going forward. I'm going to adjust this a little bit. Does that seem about the right volume? We're okay in the bank? So-so? Okay, kind of one of these means no, not really, but we're not sure how to guide you. All right, perfect. All right, well, welcome. Just a quick introduction of myself. I'm actually pinch hitting today on behalf of our esteemed leader. Dean Taylor unfortunately could not be here. He sends his regrets, but obviously his greetings and the welcome from there. He's out traveling on school business, doing a number of things related to the business school as well as the university, and his charge of, I think, in creating what will become the most global MBA program on the planet. He's practicing what he preaches as he's been out on the road here for the last, I think, 25 days. So hopefully we'll get him back into town here soon. My name is Todd Milbourne. I'm a member of the finance faculty. Many of you look familiar, but a handful of folks I haven't met before. So I'll kind of quickly introduce myself, tell you a bit of why we're here, introduce the person that has essentially made all of this happen in these particular venues, and then most importantly, turn it over to my two esteemed colleagues that are going to present their research so that at least by 1:30 you're going to be able to leave, set up your hedge fund with a new strategy of how we might predict returns. So it's a lot of pressure on you. Just so you know, they've already been trading on it, so I think they've captured any alpha that was there. So my name is Todd Milbourne, member of the finance faculty. I've been here now for 19 years. I'm also the Vice Dean of Faculty and Research. It's kind of the equivalent of being a general manager for a team where we're out there trying to hire faculty. So I work with all of our individual areas, both accounting and finance, as well as operations and strategy across the board, as we are trying to add to our faculty, both from a research and a teaching standpoint. So we're a bit like a mid-market baseball team. This is for Lewis right here. So we've got, a pretty good sized payroll, not quite, Chicago, Boston payroll, but maybe a St. Louis payroll from there. Obviously an attractive team, not on a baseball standpoint, but from a faculty to join. I'm a Chicago boy, so Lewis and I have to take our turns on this. I'm going to keep the mic away from it as we're going forward. As we're trying to hire some people and really grow across the board. So keep an eye out. I think we're moving the needle. We've got some offers out to some exciting people to lever up on an already outstanding research faculty, and you get a little bit of a sample of that today. Now, these Olin Research Business Seminars or lunches that we've been putting together have really been I would call the output of Dick Mahoney, who's sitting up here at the head table. Can we get a wave for those that haven't seen Dick before? We owe a huge sense of gratitude to Dick for creating not only this series, but really sort of alerting the faculty focus to try to find more practical applications of the things that we tend to do from a scholarly standpoint. So Dick, who is our distinguished executive in residence, was a former CEO of Monsanto. One of my most regular faculty members around. I don't have to pay him. He just comes by. He actually donates money, so it's an ideal. That's right. We'll worry about that. I'm going to extend it the same terms, maybe even add 10%. 10% of zero works very well. So no, Dick thankfully works for free. But he's around, he works with faculty, he talks to students. But specifically related to this event, he had charged Dean Gupta about a decade ago, maybe a little bit more than a decade ago, with some pretty blunt language, which tends to be the way that Dick articulates. Says, you tell me you've got these great faculty, Allegedly, they publish, which is true. We actually do publish in the appropriate academic journals. But as Dick aptly characterized, no one actually reads those outside of the 12 sort of nerds that are like us that are working in that particular space. And so what Dick created was actually the Olin Award, was to look for research that impacts business in a most significant way. So each fall, we do a call for papers among our faculty to take something that has either been recently published or is very soon to go into the journal process, which we'll call our academic paper, and then to attach to that something that's actually written in plain English of how does this particular bit of research actually apply to business leaders, whether it's something like an asset manager, like say the paper today may be, whether it's a CEO thinking about resource allocation, whether you're working on the talent side of the house and trying to motivate employees, is how do you take this sort of fundamental scholarly research and actually move the needle for people that are making real decisions. It is a prize that is it's definitely led to some competition among the faculty. We have not had a 3-time winner yet, so there's a couple of 2-time winners that are trying to vie for that first Triple Crown across the board. But what it's really encouraged us to do is to think a little bit more broadly than just our academic audience. With that, we tend to select, obviously there's a winner that is selected in this. That will be being announced here probably within a couple weeks, isn't it? Within a couple of weeks, so we won't tip our hand of who the winner is for this most recent round. But what we try to do is to take the best 4 or best 5, depending on timing, papers that have come through and actually present them in forums like this. And that's why we're here today. Sometimes these have been at breakfast. They seem to be a little bit better attended at lunch. That was my passive-aggressive point of let's see if we can keep these at the lunchtime hour. But it's great to see everybody here. We see alums across the room, I see some of my fellow faculty, I see some other friends of the school that come in and participate in different ways. So once again, thanks for being here. With that, I want to turn it over quickly and introduce my 2 research colleagues, only one of which I believe is going to be doing the presentation. But Professor Schumann Martin, I'm going to get a little wave and then I'll get you to stand up in just a second. And Professor Guofu Zhou, where's Guofu hiding? He's in the back right over there. Professors Martin and Zhou have both been here for an extended period of time. So Schumann, my colleague over here, is actually a senior member, a full professor of accounting. She works in accounting, but primarily does research in what I think of as really the corporate finance or financial markets area. So she has the pain tolerance or willingness to teach accounting, but she comes over to our side of the hallway and actually works on problems that to me are a little bit more interesting on a finance side. She actually joins us. We kind of got lucky to get her. She was a homegrown asset at the University of Missouri, and you've been here since 2007? 2007. So while not the most mighty in stature, she is the faculty member that terrorizes me the most. So anytime she asks for something, she always gets an immediate yes from me because she gets into her research. You're going to see it in the passion that she goes through. When she wants to make something happen, she absolutely does. So we're very lucky to have her, and she'll be presenting the paper today. Professor Zhou, who's going to take all the tough questions, I'm told, at the end when we come back around. Guofu has been here since 1990, did his PhD at Duke. His research is more in what we call asset pricing, which is our kind of finance way when we put our pinky up of saying he focuses more on capital markets and investments across the board. So our sort of method of attack for this presentation is we're going to let Schumann come up and present. She's shooting for around 20 to 25 minutes. We're going to ask that you keep your questions until the end. We'll leave about 15 to 20 minutes for an active Q&A period. If there is a clarifying question, and I will be the arbiter of whether I think it's a clarifying question, otherwise I will just hand the mic back to Schumann. If you do have a quick clarifying question just for flow, we'll take those during, but otherwise please keep your questions to the end. Rules of engagement seem okay? It almost seemed like you had a vote there. Now, that's years of teaching experience right there. So with that, without further ado, please join me in welcoming Schumann Martin to the stage.
Well, first, thanks everybody to attend this event and taking your valuable time to participate in my discussion of the paper jointly with Guofu. So I cannot agree more with Todd about Mr. Mahoney. You know, since I joined Olin, Mr. Mahoney has been giving me some research ideas and advice, on what I do. And he's genuinely very passionate about research. So I feel indebted to him for all the years. Thank you so much, Mr. Mahoney. Now I'm going to go into my paper. So this paper, as Todd discussed, that this is has an assets pricing implication. So in this paper, we study how manager sentiment will have implication on future stock returns. So this paper is jointly with Fu Weijiang, who is the student of Guo Fu. And then Josh Lee, who was my former student and now is University of Georgia. And then Guo Fu, our professor here. And this paper is forthcoming at Journal of Financial Economics, which is kind of one of the leading journals in finance field. So my roadmap today is, first I'm going to discuss what the question is about, which is pretty intuitive. And second, I'm going to discuss why manager sentiment will have implication for future assets price. And then third, I'm going to talk about, because so many attendants there are from assets management side. So I want to talk about how we measure this manager sentiment. And then I'm going to discuss our results, what we find, and in the end, I'm going to conclude. So the question we ask here is, does manager sentiment predict the future aggregate stock market returns? By prior research, what does it mean by sentiment? So sentiment means excessively optimistic or pessimistic projections going beyond that is supported by their business fundamentals, right? So if I'm very exuberant, going beyond my fundamentals suggest, then that's optimistic. Or I'm excessively pessimistic, going beyond the fundamentals suggested, then I'm pessimistic. So that's how we define manager sentiment. Then I'm going, as I discussed in the roadmap, I'm going to discuss how we measure that. So why we think manager sentiment will have implication for future assets pricing? First, we say managers, you wouldn't disagree with me, they are one of the important decision makers in the business, right? So they have decision rights. Second, managers, they know presumably more about their business than general investors or consumers. And third, managers may be subject to some behavioral biases, right? The prior research documents that managers, maybe they're overconfident about their business, about what they do. So all these things, we think that will say that managers, how they feel about the business may have implication about the future pricing, right? Then now let's go to the investor side. Investors, they may follow what the managers say, right? If investors believe that what managers genuinely believe, what managers feel about their business, then we think this overvaluation or undervaluation may pan out in the future, right? So that's kind of why we think this makes a lot of sense. Then you may ask why we think, or why we decided to go down this route to study manager sentiment and future stock returns on the aggregate. Because as Tom mentioned, I'm accountants. Accountants care about the information, right? And the information a lot of times are the input for the investor to decide the assets price, to value the assets. Therefore, we think we have a perfect marriage between accounting and finance. So that's why we go down this route to look at this question. Now let's go to the theory. What does the theory suggest? That there may be some sentiment that can swing the asset price. So prior research suggests that when there is some presence of limits of arbitrage just basically means, well, there's some market frictions. Either the frictions come from regulations or the frictions come from the business inherent characteristics. Doesn't matter where it comes from, there's some frictions that prevent some fundamental driven investors to arbitrage those mispricing. So prior research suggests that when there's a presence of the limits to arbitrage, then this overvaluation and undervaluation can prolong. Okay, that's what the prior research suggests. And just give you some anecdotes. For example, at the end of 1990s or early 2000s, there's an internet bubble. And that seems to be pretty clear that's an overvaluation of the business. And in the end, that internet bubble bursted. Another example or another episode in the US is 2008-2009, the subprime, right? The subprime crisis. And before that, or the time leading to that, we can say that pretty much the housing market was overheated due to some regulations, due to some, we call it agency conflicts or agency cause of those rating agencies, whatever. There's multiple factors may contribute to this heated economy, and subsequently it burst. It went to the crisis. And so is a Chinese stock market. Not sure if you invested in the Chinese stock market. If you did, or you do, you may notice that in 2015, there was market crash, okay? The market crash in China partially came from the regulation, okay? The Chinese economy, the central governments want to keep the stock market going, want to keep that song singing. However, that way goes beyond the fundamental can support, so there was a crash. Okay, so all these episodes suggest that overvaluation and undervaluation could happen in reality. So now, before our paper, there's some academic papers show that investor sentiment could predict the future stock market return on the aggregate. For example, these two researchers, 2006, that paper, and Guofu's own paper, right? Guofu's own paper built up the investor sentiment index based on this prior research, and they can predict the future market returns on the aggregate. Also, household surveys that measure the consumer exuberance, right? And those can predict future returns. Also, the recent paper, 2015, they used the internet search for some negative keywords, for example, bankruptcies, for example, the recessions, and those internet search reflect some investors' sentiment, okay? And those that index predict the future returns. Overall, so prior research before our paper, they looked at investor sentiment, how that can have an implication for asset pricing on the aggregate. So our paper came in to say that beyond this investor sentiment, manager sentiment could also contribute or could also have a prediction for the future aggregate stock market return. You may say, how big is a manager's sentiment over and beyond investor sentiment? I'll show you in our results in a second. So how we measure manager sentiment? If you read our paper, basically we use two sources. One source is from regulatory filings, and you know the publicly traded companies, they file with the SEC on a regular basis. Their quarterly financial reports are called 10Q, and their annual report is called 10K. So we pulled the entire documents for 10K, 10Qs, and then we measure the manager sentiment based on the positive side and the negative side to gauge the managers, how they feel about the business. Then what does it mean, positive and negative? I'll explain to you shortly. The second source come from managers, the conference calls conducted by these business. And you may know that on a regular basis, the business or publicly traded companies, they hold these conference calls. That's the venue for managers to communicate with the investment community, right? In institutional investors or asset managers or the financial analyst. So we use the conference call transcripts to pull out the entire documents, and then we analyze the positive versus the negative side, and then we construct the index to gauge managers' sentiment. All right, so now we're going to say what does positive and negative means. We use the negative words versus positive words, and then you say, there's so many words, how could you classify they're negative or positive, right? We have a dictionary. It's kind of like we use Wikipedia to identify those words, but we are not pulling from Wikipedia. We're using the Financial Information Dictionary compiled by these two prominent researchers, Landgraf and McDonald. They use, they have expertise in terms of the linguistics. So they constructed the dictionary for the financial information, and has a classification about this is a positive word or this is negative word. Okay, I'll give you an example. So I pull out from that dictionary. These words represent positive. So for example, able, abundance, abundant. There's a variation for the same meaning. Best, better, or bolstered. So these words represent positive words. Okay. How about negative words? Abandoned, right? And bulk, bad, bail out. Bankruptcies. So these are pretty convincing, right? These are pretty bad words, right? So we use their existing tool for our purpose. We use the existing tool. We don't invent any new wheels. So to apply this dictionary to these documents, and then we construct the index of manager sentiment. All right, so now you can see we have three indices. One is the red line represents manager sentiment. We constructed. And then this dashed line represent the Bergler and Baker's investor sentiment index. And this dash blue line represents Guofu's prior investor sentiment index. So in the time series wise, you can see that the red line, well, there's some overlapping across these three lines. However, you can still see they pretty much, represent or capture some different things, right? They are not completely overlapping with each other. right? So from here you can see that management sentiment we are using or we constructed may capture different things from investor sentiment. Now we see the correlations. These are the investor sentiment indices, and this is manager sentiment we constructed. You can see that our manager sentiment correlates with these in a different degree. However, as I mentioned from that graph, they capture different things, given that the correlation is not perfect of what, right? So that allows us to explore if this measure indeed can predict the future return or aggregate market return over and beyond these existing indices. That's the roadmap for us to do. Now let's look at the result. So we use our manager sentiment index we constructed in months T to predict 1 month ahead, 3 months ahead, up to 36 months ahead aggregate market return, excess market return. Excess by excess means in excess of risk-free rate. So you can see this is what we care about. So our management sentiment negatively predict future aggregate market return 1 month ahead, 3 months ahead, up to 36 months ahead. Okay? Therefore, from here we can conclude the index we construct based on managers' field have a strong predictive power for the future aggregate market return. You may say this is in the sample prediction. How about out of sample prediction, right? Do we have the ability to predict the future market return out of sample? I'm going to show you the results. At least at the in sample, we have the predictive power ranges between 9.75% up to 27%, which is large. And now let's look at at the individual firm level. Just now we look at the aggregate market level. Now let's dive into firm level. Does our index or does the manager how they feel about their own business predict their own stock return? So we look at in the cross section at the firm level, and this is the manager sentiment measured at their own firm level. And then we control for a whole bunch of factors that are suggested by prior research to have predictability for their firm return. And you look at here, our measure of manager sentiment is positively correlated with their contemporaneous return. What do I mean by contemporaneous? For example, today I have a conference call. Let me measure, my manager's sentiment based on our construction and look at the 3-day return, right? From 0 to 3, after 3 days, after the conference call. So they're positively correlated. That seems to suggest that investors buy in what managers say. And then let me look at future returns of the firm. So this measure is negatively associated with their future return. Again, this result seems to suggest that when the future fundamentals hit to the investors, they reprice the company's stock. That leads to the negative correlation between manager sentiment today and the future return. Okay, so overall, our firm level evidence corroborates with the aggregate market level results. Again, indicating that managers feel about the economy today, they may deliver what they do, and investors believe that in the future, when the earnings, the fundamentals are revealed to the investors, adjust their belief, update their belief, and reprice the assets. Now we have additional tests about, whether our results are really, in the cross-section, whether our results are stronger in certain periods or weaker in other periods. So let me show you some evidence on that. If you look at this panel, so we break down our sample period. We have a long period of sample from 2003 to 2014. So during this period, we have recession, we have expansion. So we break down our sample period into recession versus expansionary periods. And you can see our predictive power mainly comes from recessionary periods. Okay, that means manager sentiment has a huge predictive power for the recession. During the recession, sorry. And then further, we break down the manager sentiment level we measured into high versus a low. You may be keen about, managers truly believe what they say, so they are exuberant, and then that negative predict the future returns, or they feel pessimistic about their business that predict future return, which is true. So from here you can see our predictive power mainly come from or is stronger when managers feel exuberant about their business. Okay, so when we combine these two sets of results, then it seems to suggest that managers at the tip of or at the end of the expansionary periods, they feel good about the business by, maybe it's due to extrapolating the past performance of their business, or they want to deliver what investors feel about it, whatever that's the case, and they are very optimistic. And then when the recession hits, the stock market tank, and the investors, reprice their assets price, and then that came to the predictive ability of our current manager sentiment for future returns. All right, now I'm going to show you that how our measure relative to other benchmarks. We call it benchmark because there are existing multiple indices and factors that may have a predictive power for future returns. How does our measure compare to their measures, other measures? So these three columns show you what other existing factors, or we call it macroeconomic factors, for example, dividend yields or stock market, variance that measure, uncertainty of the market overall, or it's about, how the investors feel about the risk of the economy, their tolerance of the risk of the economy using the term structure or the yield spread, etc. All these measures capture the macroeconomic factors. How do they predict the future returns, 1 month ahead returns? You can see that the stock market stock return variance, which is capture the uncertainty, has a pretty good predictive power for 1 month ahead returns. But some of these macroeconomic factors do not have much power, okay? And then how does our measure compare to these in terms of predicting 1 month return? So these results show you that our measure continue to be our measure, which is a beta. You can see this is the beta, and this is a t-statistic. T-statistic, just to tell you, this is for researcher perspective, tell you that whether they are significant or not on top of other macroeconomic factors when we put them in the regression. So you can see that our measures survive whatever, regardless of what we put it there for controlling for other factors. Our factor, continue to hold or continue to be robust in terms of predicting future 1 month return. So overall, this table tells you that our measure or our construct indeed has a pretty good predictability for 1 month ahead of returns. Now we are saying, there's remember at the beginning I said investor sentiment may predict the future returns as documented in prior literature. How does our measure compare to the investor sentiment? So that's what we do here. These measures capture investor sentiment or consumer sentiment. And you can see that we add these consumer/investor sentiment, our results still continue to hold. Again, our measure predict future stock market return on the aggregate level incremental to investor sentiment or consumer sentiment. Now, I'm going to tell you from asset manager point of view, does our measure have the predictive ability for out of sample? And you can see here, for out of sample prediction, our R square, in sample we have 9 to 10% R square. Out of sample, we have 8% out of sample R squared. That's again is very high compared to other investor sentiment measures. Their out of sample prediction only yields about 7%, 4%, or even negative, right? So our measure again suggests that this result suggests that our measure is really good in terms of predicting future market return. And then we break down into recessionary periods out of sample prediction versus expansionary periods. And you can see that, not surprising, our results are much stronger for recessionary periods out of sample prediction. Okay, now how big is the magnitude? Let's think about this. We have certainty equivalent return. That means we abstract away those risk measure, and we can yield on an annual basis 7.92% return. From the investor point of view, this delivery is pretty good. Sharpe ratio, when you maximize the mean, minimizing the variance of the asset price, you can see our measure, the performance is pretty good. It's on par with other investor sentiment measure in terms of predicting future return. If you think about 50 basis points as a transaction cost, again, our delivery of the gains to the investors is pretty substantial. Okay. So again, the takeaway from this slide is that investors can gain from using this information in terms of managing their assets. Now let's look at the mechanism, through which manager sentiment could affect the future stock market return. We think if indeed managers act on their belief and use their decision rights to make investments, then that may predict their future investments or current investments. And if that is true, the overinvestment may lead to future negative, the disappointment reflected in their fundamentals, right? So let's look at whether our measure can predict future unexpected earnings. We use SUE to capture unexpected earnings or forecasting error, if you will. So indeed, we use seasonal adjusted earnings. For example, I use this quarter's earnings, subtract the 1 year ago's earning, in the same quarter as a measure of forecasting errors. And you can see that today's management sentiment can predict negatively predict the future forecasting errors. In other words, it seems to suggest that managers feel good about today, my earnings is good, and then I'm very enthusiastic about this economy. I may overinvest, make a lot of investment today, and then in the future, there's a surprise, negative surprise in terms of reflected in their earnings. So the manager sentiment negatively predict future earnings up to 36 months ahead. Now let's look at if ROA shows similar pattern. You can see that managers sentiment today predict 24 months ahead ROA. This is a level. This is not change, whereas this is a change. Okay, so in terms of earnings is mean reverting. So 24 months subsequent to today's manager sentiment, there you can see that their earnings level goes there. Okay. If our argument is true, if managers' sentiment predict the future forecasting errors, and that motivate or that make the investors to update their belief when the future earnings is delivered, right? Then when we control for this forecasting errors in earnings, our indices, our manager sentiment measure should lose its power, right? Because I control for forecasting errors in the future. And you can see here, this beta capture the manager's sentiment here, and then this psi capture forecasting error. So when we throw in the forecasting error here, forecasting error strongly predict the future returns contemporaneously, whereas our manager sentiment lost its predicting power, right? After controlling for the fundamentals, which is the forecasting errors. So again, this seems to suggest at least our manager sentiment come from the subsequent fundamental disappointment in the future, and that leads market to revise their belief. So now, take a moment to think about our results. Our results seem to suggest that this is a mispricing rather than a fundamental explanation, okay? Managers truly believe what they do today and they act on it. They make investments in the future, and that when that investment does not pan out to be good, or that investments pan out to be really good, that make the market to update their belief, and that leads to the predictive power. Now, since I said this is an investment story, do I look at, we didn't tabulate the results. We did test on the investment, look at how the manager sentiment had a predictive power for the firm's investment decisions. And we did see that the managers overinvest. If they feel good about today, they make more investments, and that leads to 36 months ahead of predictive power. Means today they feel good about their business or economy, they make more investment up to 3 years ahead. So again, this is telling us the mechanism for our predictive power comes from managers' actions, not just what they say. All right, so now I'm going to wrap up this presentation. So the bottom line from our paper is that manager sentiment negatively predict the future market return on the aggregate, and they outperform the macroeconomic factors. They also outperform the investor sentiment that has been studied in the prior literature. In addition, the mechanism we look at seem to suggest that this comes from this predictability, come from the manager's actions, for example, reflected in their investments they take, And that negatively surprised the investors in the future, leading to this predictive power. And in the cross-section, our results are stronger for recessionary periods than for the expansionary periods. And also, among those firms, recall, because we say this mispricing mainly comes from the market frictions, and we find that indeed this is the case. Our results are stronger or highly predictive for the future market returns among firms that are hard to value, difficult to arbitrage, and they are subject to the speculations and they have high limits to arbitrage. Thank you very much. And now I conclude my paper. Hopefully this will have some implication for assets pricing or for the business.
We'll take questions.
You're a very busy lady and everybody here is very busy. How did you manage to look at all those papers, all those forecasts, and get out these words and catalog them and all that? You must have some technique, which if they're gonna do this, they gotta figure out how to do that.
Yeah, fortunately we have IBM, these business to help us to have these AIs, the robots, helping us to construct this indices.
Can any human being do this? Be a genius.
I believe the dictionary that we follow, they initially do manually. They have to kind of has a sense about whether these dictionary words indeed are capturing the sentiment. And we follow their route in our, as I mentioned, we didn't invent any new wheel in terms of constructing this, right? Or verifying this is indeed capturing the sentiment. We just used that tool to apply to managers to capture managers' sentiment. It's not hard to do. PhD students can do. And actually,
I don't know if that's the ringing endorsement for our doctoral program we were after. No, you could find a coder to do the textual analysis for this kind of thing.
Question, was there contextual analysis of the sentences? Because the statement, we benefited from competitor A's bankruptcy and competitor C's abandonment of our market, has two negative words, one positive word, which would seem to be a negative statement, but in reality is a very positive sentence.
right.
So was there contextual analysis done?
I believe so. I think I have to ask our doctor student, which is Josh Lee, and he spent tons of time investigating how to deal with those situations. But I want to assure you we did take that into account.
I have a question about, when you were looking at the future returns, were you able to differentiate what was actually improvements in the fundamentals of the underlying business versus investors' view of the business in terms of maybe PE expansion or something along those lines?
So can you please repeat your question?
Sure, yeah. So understanding when you were looking at the future returns for the company that you're looking at.
Right.
How much of the future return was either a downturn in the business versus how much was a change in the valuation or basically the risk assessment of the firm by investors?
Okay, so that's a very good question. Mainly we come from the investors' update beyond the fundamentals suggested. If you recall, in our firm level predictions, we control for a whole bunch of factors that are capturing these fundamentals.
I have a question for Gopher, since he hasn't spoken yet.
Putting you on the hot spot.
Exactly. You had done similar research that kind of related to this. Were there any real surprises here, or were the outcomes kind of what you had expected?
It's like a yes or no question. Yes, is that we said there may be some possibility, so there may be room, there may be some effect. That's why we do this research.
Yeah.
No is that, and surprisingly, they say the PhD students do this textual analysis independently, totally out of blue, then bring us results. We just put into the regression. It works much better than we expected. We didn't do any massage of this textual analysis, nothing. Just right off the shelf, put it in. It works. So that's why I say yes or no issue. Yeah. So it's really that interesting that this really containing enough information from the manager side that really, which was making sense that seems to be stronger even than investor sentiment. Because investor may not do as much as manager, so that's why manager sentiment has even stronger, longer impact. Which was earlier we thought maybe something, turns out it really is much better than we thought, which really surprising that.
Yeah, I think the extent of the surprise you probably found is on that one table where you had either all of the macro factors that show you really have almost no, very low R squared. So it's not explaining very much of the data at all, and neither were any of the other sentiment ones. So I didn't believe it when they first presented this in the brown bag, because that's a big precipitous jump.
Exactly. So, and I just want to add a little bit to Guofu's explanation. The academic research has shown that managers may arbitrage the investor sentiment, right? When investors are pessimistic about the business, and managers may have strong incentive to arbitrage that, right? To correct the undervaluation in their business. So that seemed to suggest that maybe this is the case, that managers can have strong incentive to correct the investor pessimism, but they have no incentive to correct optimism, investors' optimism, right? So yeah, so you can see that this asymmetry in terms of the predictive power is really the kind of the crux of our paper.
Over here, Jim.
When doesn't it work?
Can you please repeat?
When does your technique not work?
Not working?
Which companies, which time periods, which sentiment?
Good, yeah. So you can see from our cross-sectional analysis, our measure works extremely well in recessionary periods, but not so well in expansionary periods. And our measure works extremely well when managers are optimistic, not that well when managers are pessimistic.
Which industries does it not work in?
So let me think about from what we find there. We find this measure has a high predictive power for firms that are, difficult to value, presumably those technology-based firms, right? Hard to value the asset price, and that have high limits to arbitrage, right? For those firms, everybody can see it. It's pretty transparent. They can value it pretty well. Then this loses predictive power.
So what does the performance do if you eliminate the easy-to-value firms?
Then that will have an even stronger.
But you don't know what number, because that's an easy fix, is to pick a different sample.
Right, we did do that, but on top of my head, I think we have that analysis.
Thank you.
Other questions?
Have you concluded that the managers are lying, or are they they just don't know? Or they're just saying it's always gonna be the way it is, or are they lying?
That question is pretty hard. Well, then maybe this is somewhere in between. All we show is managers believe what they say and act on it in terms of guiding their investment decisions, right? Whether they're lying or they're doing what they say is hard to determine.
I have a question. When you talk about investment decisions, are you talking about R&D investment or
reinvestment of their own stock? Where is this investment
We look at
decision?
everything.
Because I mean, most of these companies aren't R&Ding any longer. They're just borrowing money and buying them stock back.
No, we do not look at stock buyback. That's a share repurchase, so that's not part of the investment. What we look at is CapEx, merger acquisitions, and R&D, all these.
What are the factors that you considered in defining hard to value, and how did you apply them?
Right, that's a very good question. We use the market to book as a measure for hard to value, right? When firms, have a high market value relative to their book value, that's kind of suggesting that these kind of firms are hard to value.
Was there any geographic separation where you looked at performance in North America versus companies that are global and other things?
No, we focus on U.S. firms. We do not.
North American only, others are multinational, even though they're U.S. based.
True. We don't look at their business segments, where they expand their business across the world. But presumably multinational firms, but this is a good question. We didn't look at that aspect. I cannot use our results to make any speculation on that. Presumably if you think about the geographical area, like a Bay Area, San Francisco, that mostly technology firms are, then our results seem to, I wouldn't say no to this.
How about size? Any difference in larger firms versus smaller?
Right. So again, I just use our results to kind of speculate on that. Larger firm, presumably, they are more mature firms, right? And relatively, they're easier to value. Than smaller firms, they may have a higher growth opportunities and hard to value. But you can give me the counter example, like, Apple, these are big technology firms. So, yeah.
Was the greatest correlation between sentiment during the recession and results during the recession, or was it sentiment right before the recession correlated with results during the recession?
The results during the recession.
But in the sentiment, just immediately prior to the recession.
Exactly. That's why we say at the tipping point, right? At the end of the expansion, when we measure the manager sentiment, they may be very exuberant. And then when the recession hit in the next, 1 or 2 or 3 months, then we see this predictive power.
People tend to vote with their feet or their money. Did you look at all in the market? Did you look at all management's action with respect to the stock? In other words, insider buying, and how that might connect with the factors?
So the short answer is no. We didn't look at that. We didn't look at that aspect. So let me take a guess. Our results show difficult to arbitrage for the firms that are difficult. Their stock is difficult to arbitrage these misvaluation. Presumably, are those stocks they have lower institutional holdings, more representation for retail investors.
If it's really most predictive at the tipping point, isn't that just suggestive that managers aren't that good at predicting when the recession's going to hit? Because they're just not they could be saying, well, we're going to go like this, we expect a recession, but maybe further out. I mean, that just doesn't seem to be saying I'm over optimistic. It means I just not that good at predicting a recession.
Yeah, it could be reflecting that aspect, because here we're not accusing managers are, faking what they say. They may just truly believe that. And, like what you said, they have difficulty in predicting the future, downturns, right? For example, we listen to CNBC now all the time that asset managers were asked by the CNBC's people, when you think this stock market is going to be going down, right? So what I keep hearing, the recurrent theme is that, 2019's stock market is still going to do well, the fundamentals are good, right? So I'm not saying that they are lying. They may just telling us what they really believe.
Any other questions? Right on time. Well, please join me again in thanking Xiumin and Guofu.
Thank you so much.
Well, thank you again. All right, another shout out to Dick Mahoney. Thank you for inspiring all of these across the board. These are always fun. So hopefully you enjoyed that. If you've got ideas, questions, you want to connect with our faculty, you can either grab me or members of our corporate relations team. We should have them right up here. And I think Ryan was just outside as well. So Steven's here, Ryan's here. Dorothy is traveling with the dean, keeping things rolling. But I'll stick around for a little bit. Otherwise, if you do need parking validation, they do have a few of those little golden tickets out at the table out here. But with
One plug. One of the benefits the faculty get out of these lunches and doing this whole operation is getting relationships with your company, particularly relationships that lead to data. That's what they live off of. If you've got a program that's got information in it that might be interesting in this general topic, I'm sure Xiumin would love to be talking to you because that's what they live off.
No, I would echo that. I'll go ahead. Xiumin for sure. I know she will get it. She'll probably win because it was already established. She's our toughest cage fighter of our faculty across the board. But we've worked on a lot of these relationships where oftentimes you've got data. Maybe you don't either have the time, the resources to deploy to tackle some of these things, or you just don't have sort of the collection of nerds that we keep together in our little place here that can do things like quickly code up the textual analysis from there. So we've got teams of students, doctoral, and faculty. We've got some very rich collaborations, and I thank you, Dick, for pointing that out. That is always something we are looking to grow, and I think it's a pretty symbiotic relationship when we've had that work. All right, with that, thank you again. Be well for the week.
Thank you. Yeah, it's good. It's good to talk to from business point of view.
Hey, I didn't say anything.